Hello and good morning to those of you in the Western Hemisphere, in the Americas. Good afternoon to Europe. Good evening to all of you in Asia and Pacific and Australia. And welcome to our July SaaS Valuations update. Very happy to see you here. You're the most avid followers of our research in the middle of July. I really respect that you are keen to learn what's happening in the industry. So to those of you who have not attended our previous webinars, I'm Marcin Majewski. I'm the founder and CEO of Aventis Advisors. And I'm here accompanied with Philip. Philip, say a few words.
Hi, I'm Philip. I'm M&A Director at Aventis Advisors. Nice to see you all.
So as always, we're here for you to share our most recent insights, to help you make better decisions when it relates to your investments or exit strategies, and in particular relating to SaaS acquisitions and SaaS exits. It's an exciting time in the financial markets, even though it's summer, but there's still a lot going on, so we'll try to unpack it and give you our take on what's happened so far this year and what we can expect going forward. So it's an exciting topic to cover. So let's dive in, Philip.
Let's dive in.
So the name of the game today is Taco, which explains a lot of the gyrations in the financial markets. But to be honest, as everyone familiarizes themselves with Taco, and for those who don't know the abbreviation, it means Trump always chickens out. I think eventually we will get immune, but still Trump has the capacity to move the markets. And the last webinar we held in April for SaaS companies, SaaS founders and investors, we promised you we would revisit the topic of SaaS valuations after 90 days from Liberation Day. So for those who might remember what happened back in April, there was an announcement of tariffs, reciprocal tariffs in the US on basically the rest of the world. That was then soon suspended with a 90-day deadline. And then over the course of 90 days, America was supposed to close trade deals essentially with the rest of the world. This hasn't happened. Obviously, Trump didn't follow through with the reciprocal tariffs, or not to the extent he promised. There have been very few deals. Notable was kind of the UK and sort of a ceasefire with China. But otherwise, this is still pending. And I don't think this will happen really in the foreseeable future. I mean, not the extent that was announced back in April. So I think the dust has settled. People kind of discounted all of the talk about tariffs, and we're here to tell you how this is translated to SaaS valuations. And we were quite surprised with what happened. So Philip, let's put some perspective on it.
Yeah, I mean, the markets were down and then now back at all-time high. So we thought to see what's up with SaaS. And starting from a big picture and looking at the 10-year view of SaaS, all the recent gyrations are super minor, actually. Yeah, it was a bit up, a bit down. But if you look from a 10-year perspective on what we were seeing in 2016 to 2020, rapid growth in multiples, then during COVID times, massive increase, then a big decline, and kind of slowly declining over the past 3 years. All the political news kind of were not affecting the headline revenue multiples so much. So what we're seeing is for our basket of the biggest SaaS companies, 1 billion plus market cap, listed in the US companies like Adobe, Salesforce, Zoom, they're still around 6 times revenue. That's a median number. And for an overall basket of SaaS, which is much bigger, 200 firms all across the globe, that's around 4 times. So kind of in the big picture, the changes are not so significant, but if we actually zoom in a bit and see the last 12 months, then we can see there's been a number of events that affected multiples, and they were at one point at around 5, at one point at around 8. But the conclusion is we're kind of finishing up July where we started a year ago. In the meantime, there's been a bit of increase when Trump got elected. US markets grew a lot. Everyone was optimistic about the president, and some of the uncertainty was removed. And there was this period when companies were traded 7, 8 times. And then kind of slowly as this trade war rumors started to come in and people understood that that's for real, the market started to decline together with SaaS valuation multiples. Big drop on Liberation Day, then the reversal, it came back, and now it's just a bit smaller numbers than it was before Liberation Day at around 6 for the largest US listed companies. I think interesting point here is that all SaaS actually grew during that period. So it was around 3.4 before and now 4.0. So kind of European companies and companies all across the globe benefited a bit and closed the valuation gap here.
Yes, it has a lot to do with exchange rates.
Yeah.
If you're a European holder of US equities, you're a bit worse off. I mean, if you own SaaS companies. And the opposite, if you're a US holder of European SaaS companies, then you've gained quite a bit thanks to the exchange rate. In the meantime, and I noticed one of our attendees raised a hand. If you have any questions, feel free to type them in the Q&A session, and we'll take them after we finish we go through the deck. We really enjoy your questions. So we'll take them after the slides.
Okay. So moving forward, March in US and non-US SaaS, what we touched upon a bit already.
Yes, this is very interesting what we're observing, that there was a wave of optimism for US stock market and US SaaS valuations in particular, following the election of Donald Trump. This only lasted until February. And then after Liberation Day, basically the trend reversed. But still, I mean, there is a significant premium because it's 43% over their peers in other countries. I mean, that a lot, it has to do with the size premium.
Yeah.
Although we tend to see more profitable companies in other countries, but definitely size is the advantage of US businesses. That's when you have to deploy large sums of money, there's no better market than the US. But otherwise, I mean, if you look for value, probably it's better. There are better companies in other countries. But when it comes to an exit, finding a buyer, there's not a better buyer probably than a US corporation, just because of the the firepower they have and the arbitrage they can have if you're from another geography. So this is still happening, and I think this trend will continue for the years to come.
Yes, I think the premium is here to stay. It's the largest market in the world for a software company. It's also the largest stock market, so most liquid and the largest exposure to the investor. So even if it can changes a bit, and in the past it was much more. I think at peak of COVID it was way above 100% premium for US company. Now it's smaller, but I think it's here to stay long term.
Yes. So let's move on to the next one.
The growth rate, yeah. I think that's one of the most important KPIs for SaaS company. And that's kind of where the recent underperformance and decline in multiple is coming from. What we're seeing is that the growth rate has been slowing down for quite some time for SaaS companies, really from the beginning, when they were growing at 30-35% 10 years ago, and really kind of best in class, fast growing companies. And then it started to decline as with any industry is maturing, so the growth is declining. Profitability may improve sometimes. We had the one big moment during COVID when the growth just jumped for more than 10 percentage point over a quarter, as you know, everyone was investing into software tools, into Zoom, project management software, and kind of overall trying to bring this work from home environment up to speed. That kind of slowed down the deceleration, and was one of the reasons why the multiples were so high in that time. Yeah, so it's not only helicopter money and low interest rates, the fundamentals of SaaS companies also were much better. That's like from 22% back to almost 35%. You know, if you think that's going to continue, then why not to pay a big revenue multiple? But then again, that was a one-off. So now in hindsight, we're seeing the growth continues to decelerate, and quite a lot in the recent quarter. We look at the median revenue growth rate for those 70 biggest companies. So last quarter, Q1, which is reported, it's almost -2 percentage point in one quarter, which is quite a lot. So as the revenue deceleration is there, yeah, and I think just the new revenue is not coming in. So from what we're seeing, companies have problems with signing new customers. So even if your net revenue retention is good, just difficulty to gain new customer, your growth rate declines. And that's where the whole story of revenue multiple and kind of being a fast growth company but no profit company starts to collapse a bit. And that's kind of one of the biggest risks we're seeing, is that if you're a SaaS company growing at 10% and still not profitable, then why is anyone paying a revenue multiple for this when it's very close to a company from a traditional industry? So if you think about it, like a $10 million revenue company, which generates 1 million in EBITDA, 3 to 5 times revenue, so $30 to $50 million for companies that generates $1 million in profits and not growing much. That seems excessive, just kind of from a common sense point of view. So taking into account this growth slowdown, but still good multiples, I think it's still quite a good environment for founders and sellers in terms of valuation. So it could have been worse, and we could see companies trading at EBITDA multiple, and we're probably gonna see this in a couple of years as the industry continues to mature. But now, even with this revenue growth rate, which is already close to 10%, very conservative, we're still seeing revenue multiples. I think shows the environment is quite good.
I have a question. Sorry, Philip, here.
Yeah.
This green line, and the little hockey stick that is forming here, are we really buying it? Do we see any reason why the decline in growth rates would stop? Because it looks quite optimistic, the recovery, that there is some bounce back. But is it for real, or is it an artifact, a bias of analysts that cover these stocks that makes them biased towards growth?
I mean, it's a bit of an artifact of how stock markets operate globally, that for the next quarter we see it continuing decline. So the bar is set low, so companies can overperform and report, earnings surprise or revenue growth surprise in this case. And then they say, it's gonna recover in the latter part of the year or further down the road. So I think it's probably gonna be a bit of a decline. I think we're gonna end the year at around 10%, maybe a bit lower.
So if the consensus basically is that growth will recover, but we don't expect this to happen, then probably valuations will continue. I mean, we'll be in a downward trend once there is news and people realize that there is less growth.
Yes, I think one more interesting point here is when we look at AI and how that affects SaaS companies, there's been a lot of talk about how that's positive for SaaS companies and a new revenue stream. And a lot of companies introduced new pricing plans with AIs or some tokens or some extra revenue sources. But we're not really seeing this in the big picture data. If you look at COVID, that one-off was just amazing, like plus 10 percentage point of growth rate in a quarter. So here it has a big effect, then we're not seeing it at all. And I think we're gonna talk a bit further about that, whether SaaS companies are benefiting from AI or not, actually. So let me finish here. On the right, we plotted this EV revenue to growth ratio where we are.
Let's explain this, Philip, because this is a new term to most people.
Yeah, we're analyzing, how much multiple you're paying for a unit of growth. So, if you have a very low growth rate but high EV revenue multiple, it's higher. And if you have bigger growth rate, lower multiples, and it's lower. So kind of lower means undervalued, higher means overvalued. And looking at the past couple of years and disregarding this, 2021 period, which is one-off, we're still quite high. So we're still paying a big
extremely high.
Yeah, we're still paying a big multiple for a unit of growth. And
and the way we, just to give more context, the way we came up with it, the main driver of valuations for SaaS companies so far has been growth, not EBITDA. We had a question from one of our attendees. So we try to find an equivalent of PEG ratio, P to E to growth, which is a very important KPI for stock, for more mature, regular stocks, let's say, not non-SaaS. So we found that this is more relevant because they are usually unprofitable, or many of these stocks are unprofitable. But it looks like these prices are exorbitant right now, because we're not very far from the COVID peaks today.
Yeah, and if you think about it, we are showing on the left the median growth rate. So it means half of the companies are lower than this. And it's, can be 5%, can be 10%, and still the revenue multiple, which is quite good.
Yeah. So is software eating the world after all?
I mean, if you look at the revenue overall, this is a massive market. Yeah, I don't remember. It's $1 trillion market or so.
Yeah.
I think that's the problem, that it already ate the world and there is nothing more left to eat.
Maybe. Yeah.
But there's someone else who's now starting to eat in the world. I think it's
We'll
esoteric.
talk about that.
Ah,
Yeah.
yeah, so we looked here at AI and SaaS. Yeah, kind of two big topics right now. One maybe is kind of becoming a bit more boring, and one is very exciting and it's a new shiny thing on the market. And we plotted here a number of stock market indices. In purple there is the SaaS index, and black is AI index, and blue and red is S&P 500 and Nasdaq. And how we compiled this AI index is we took companies that dropped a lot during DeepSeek scare in late January, when suddenly everyone became aware that capex may not be there, and it may be much less costly to build models. So we took companies across the AI value chain, from data center construction, electrical, utilities, electrical components, HVAC, and so on and so forth, and constructed this index. It's an equal weighted index. There's not much NVIDIA there. It doesn't correspond to all the overperformance. But what's very interesting here is this big difference between SaaS and AI companies. And the AI companies are not really even software companies. A lot of them are very traditional businesses. And it seems that investors are really shifting to investing in AI companies, and sentiment is shifting, while SaaS companies underperform and kind of generally flat over the past couple of years. And AI index just goes through the roof, and it regained all-time highs after this short decline after DeepSeek. One more point here is that when we looked at DeepSeek and what happened on the day, we saw a lot of companies having their stock prices declining, like NVIDIA, more than 15%, Broadcom, electrical companies, and so on and so forth. But SaaS companies were not moving a lot that day. Yeah? So it seems like the markets are not really considering them big benefactors of AI. So if you look at what happened after DeepSeek, big drop in AI index, SaaS index relatively flat. So it feels like investors are thinking, yeah, there's a big boom in AI, but SaaS companies are not AI. And even while the executives, continue to say AI dozens of times on earnings calls, like no one is buying this anymore. And SaaS companies are about software. They need to show the revenue growth rate and sell software, and AI is very, very different.
Yes.
So Marcin, who do you think will benefit AI? Which layer, as it is said these days?
We mentioned that in the previous webinar on AI valuations, that picks and shovels, the whole supply chain to the AI industry is a big benefactor. And it's a bit, much less risky than being on the front end of AI research, because someone has to provide the air conditioning, someone has to build the grid, build up data centers. And these companies are making a ton of money while the gold rush lasts. Whereas, there's a lot of inherent risk. And for instance, Perplexity, recent darling of AI valuations, I think there's a lot of doubt about long-term viability of their business model. Now with OpenAI basically taking up market share, Google's response, is there room for Perplexity? We don't know. So basically, yes, the entire old school industries are being reinvigorated thanks to AI, which is actually counterintuitive. I mean, counterintuitive. It's a big surprise for us how vast the reach of AI is and how big a change it is for the whole global economy. SaaS, I think there will be companies that adapt to the new environment, but I think SaaS is under big threat from AI. Also because attention shifts, not only of investors, but attention of customers. And then when they're playing with AI, they can't use the time to tinker with their ERP. So, and a lot of enterprise systems, like I know, BI is changing. No need to go through building reports, visualizations, if you just can query a chat interface to get an answer. So I think we'll see a lot of disruption in this space. And I don't think it's that great for this industry.
Yeah, I think it's important to know that we have in our index just pure play SaaS companies. So, for example, we don't have Google, Microsoft, or AWS, Amazon. Yeah, because those are not really SaaS companies, or Microsoft has a bit of a SaaS component, but it's not half or more than half of their business. They have a big cloud business, such as AWS, as Google Cloud Platform. And those seem to be benefiting. Those companies are part of NASDAQ, so they performed quite well during this time, but we haven't seen big winners in just pure play SaaS companies like Salesforce or Adobe. They don't really have their own LLMs. They just have, functions or features which are based on some other companies' models. Okay, we've touched a bit on profitability margin. So, would you comment on this?
I think this chart is remarkable. There were already 2 attempts of SaaS companies to break even. Back in 2019, I see here, back in 2021, and finally happened in 2024, which is basically 25 years after Salesforce was established and kind of initiated the SaaS revolution. And it seems we can't expect very high profitability from SaaS companies looking at this chart. I mean, it looks like it's going to peak, and that's actually quite scary that I think the patience of investors for these companies might be ending. And we had a discussion about SEMrush yesterday.
Yeah.
The company, for those who don't know it, it's an SEO company, analytics company. And they turned a profit for the first time this year. I don't remember how long their history is, maybe 20 years. But at the same time, their industry is being massively disrupted by AI, and this is going to be reinvented because the whole SEO industry is going away, really, SEO industry as we know it. So I think investors are kind of losing faith, I see, that these companies will ever turn a profit, especially with the threat of AI. So I do hope they make more money in the future, but and I think that the trend will continue. Just the increases in profitability will be very slow, which means you should not probably expect the EV revenue to grow by much. But I think for the next webinar, we can start analyzing EBITDA multiples a bit better. That would be interesting to see how these companies trade. As we said, it wasn't really relevant before, but I think it's going to be more important going forward.
Yeah, I think some of the companies are very profitable. Some of the largest ones like Salesforce, Adobe, Intuit, they have, I think, 30% plus EBITDA margin. The thing
Yes.
is where like the examples and everyone thought you can replicate that quite easily. And now the years pass and turned out not to be that easy, as the companies are still around 0 or less than 10% and have to continuously invest in R&D.
Yeah.
And they have to continuously invest in sales and marketing because it just became more competitive. It becomes more difficult to acquire new customers, and you kind of want to have the story of a fast growth company, but the revenue growth is declining, becomes more difficult, but profitability is also not there. It's kind of caught a bit in the middle. So is it a mature profitable or is it a fast growth industry? Yeah. I think in the next slide we'll discuss where do we go from here, Marcin. You're supposed to be a bullish case. So what's your bullish case from here?
We agreed I would be bullish, and
Yeah.
I will stick to it, but I will be selectively bullish. I think because the sentiment isn't great for the SaaS industry, there might be a few companies that are kind of hiding in the shadow somewhere, undervalued. And there might be some companies that are great buys for sure, while everyone is watching AI and all the capital is going towards AI. And also, I think there will be a handful of companies, especially the Max 7, that will ride the wave of AI and make a ton of money off of it. They're not in our SaaS group, in our SaaS peers, because their SaaS revenue has a minority share in the revenue. But I'm quite sure if you look closely, there will be a ton of opportunities and companies that are able to reinvent themselves with AI. But then I think a lot of analysis should be fundamental, should be very strategic. But I'm quite sure there will be winners and losers in this, and if there are winners, they will be quite spectacular. But unfortunately, I have a feeling most of the companies will be losers in this AI revolution, and will not be able to completely reinvent themselves. But then, I mean, there will be good cash cows, probably. They have if they have a sticky product. So that's my bullish case, but with many reservations. But I did try.
Yeah. I think one point is the sentiment and this be greedy when others are fearful. Maybe, as you said, there are a couple of companies which are undervalued these days, and you can find some gems.
Yeah.
But I think overall, for the market is a bit of a bearish view because the growth rates continue to slow down, and that has been always the main story for any SaaS company. That this is a fast growth company. That's why it's valued at a revenue multiple. That's why profitability doesn't matter. They're investing in future growth. So it's a much more difficult story to sell once your growth rate is low, like at 5 to 10%, because then you're just all your investments are not bringing much value to the company. And I think one of the reasons for this is actually AI, and that the budgets of big enterprise clients, their attention just shifted to AI, and all their investment and capex that they had for maybe ERP implementation or some new software purchase are now directed to LLMs, buying premium ChatGPT subscriptions or just
Yes.
trying to build something internally with the help of IT services companies. And IT services companies is, I think, where we actually are seeing a bit of a rebound. So maybe no combination of LLM AI companies plus IT services would be a winning strategy. We saw this in the news actually last week when OpenAI started own consultancy business for the largest clients. So they want to implement their solutions directly to big clients and kind of maybe skipping this SaaS layer. So companies have their internal solution connected to OpenAI. Yeah, so that's the second point. And the last point, I think, is just investor sentiment and a bit of tiredness that the industry has been around for 10 years. And now investors just want to shift their focus on something new and invest in something new and look for the next, companies that gonna double or triple or 10x in price. And that's probably not a SaaS company anymore. It's probably something in AI, in data centers, or some early stage startup, as we've seen many examples recently, companies with a couple of people selling for tens of millions of dollars. Yeah, that's where the big gains are. And here it just became more boring and closer to the market return overall.
So unfortunately, we're more bearish than bullish, even though I wish I could be more bullish. I mean, there's also one positive thing that global SaaS might be rebalancing a little bit with the US, and there are companies in overlooked countries that might be doing very well, because also SaaS adoption by country, it varies, and there are markets that are very mature, but there are also markets, developing markets, where there are very few users of software still, or SaaS in particular. So there's still a lot of room to grow, but definitely it's harder to find it.
I think the valuations overall are quite high given the KPIs. Yeah, so that's
absolutely.
So if you think about any industrial company which grows at 10% and has 10% margin, that's gonna be 6 times EBITDA. Yeah, and here we're seeing still maybe not 6 times, but still revenue multiples, which is very good.
Yeah.
So to sum it up.
Yes, uncertainty continues. We're still affected by global tensions and what's going on in the US, going on in the Middle East, what's going on in the Ukraine. And I think there's more to come. I don't think this is going away in the near future. I think we're in a 20-30 year period when there is going to be a lot of turbulence in the world. So so there's definitely that happening, and it keeps the sentiment quite low for this industry. So yes, we've discussed a lot about growth decelerating. It's harder to win customers, harder to get their attention. The market is mature. Everyone is loaded already with different solutions. I mean, let's say the corporates and the early adopters, they're using SaaS extensively, which means it's getting harder and harder to convert people to use SaaS. You have to win basically business away from other customers, and that gets very difficult. So that's why also the revenue multiple is going away. And then lastly, so there's shift to AI. I think those who can ride this wave well will be winners, and SaaS companies in particular. We've seen a lot of companies do it well, but I think a lot of them are being a bit too shy still about it. and not doing enough, and they might get disrupted by new entrants. So yeah, so I think what is important is to wrap it all up. That valuations are still high for SaaS companies based on their fundamentals. I think it's still an environment in which for sellers, they can get good deals for themselves. And if you have a mature company and the growth is decelerating, I think it's a good time to consider selling. If you have an AI first company, if it's doing well, if you're seeing traction, low churn, probably it's better to raise and keep building for the next few years, because for such companies, I think valuations are gonna grow through the roof in the next few years. So yeah, Philip, anything to add from your side?
Yeah, I think it's a good summary. I think the most important point is about the revenue growth, that each owner or founder of the business should really think about the next 3 years and kind of where they see the growth and their profitability, and think maybe you can get a better valuation by just selling the business to someone who can pay you, I don't know, 20 million, and now you're generating 1 million in cash a year, and kind of 20 times future profit, which is very uncertain. To me, that may be quite a good deal.
Yeah.
So with that, I think we can jump to the Q&A. And
we've had great questions, some of which we answered, I think, already. Okay. Yes, the slides will be shared to all participants. Will send them by email, a link to the deck and the recording. Okay, from Ahmed. It's 4 times private companies multiple. It was all the benchmarks we present in this deck, they're for public companies. So usually there's a discount, 20, 30%, 50% sometimes for private companies. So the next question, thank you, Ahmed, for your active participation. EBITDA multiple for valuations. Yes, this is totally what we're gonna do next. I mean, we usually do it for our clients when they're profitable, but because this is a recent phenomenon, profitable publicly listed SaaS companies, we couldn't really do it so far. So, and I think still a lot of companies are not profitable even on EBITDA level. So this will be quite difficult to do it. Okay, what is EVRG ratio? I think we explained it already. And I think there was another one from Adam about EVRG. Oh no, for what is a normal EVRG? I mean, so this is something we came up to adapt PEG ratio to the SaaS world. But I think, I mean, fundamentally, I think 10 to 20 would be healthy. But I think, yes, we can take it in the next webinar, and it will be interesting to do a fundamental analysis. What is a healthy level that is justified by long-term trends and by DCF, basically reverse DCF that we could run on this. Good. So good questions. What do we take next, Philip?
Will there be space for future SaaS companies to start and succeed like the well-known names? I think it's very difficult these days. Yeah, I think as the industry is mature, there are very big players, and to
Yeah,
build something from scratch, specifically in SaaS, if you're meaning something that competes with Salesforce, Adobe, Asana, Atlassian tools like this, I think it's
yeah.
going to be very, very difficult, and it's better to do something in the AI space.
I would come back to the rule of 40 narrative, which basically stipulated that you can run a company either for profit or for growth, but you are free to decide and you can shift EBITDA or profitability. I think in today's, I mean, this was a big fallacy, I think, this thought, because as the industry matures, growth is more hard to come by. It's becoming more expensive because you have to steal away customers from somebody else. And it seems it's for a lot of companies, it's extremely hard to turn a profit and maintain revenue. That's why we see a lot of companies that are not making any money because they plow back all of the earnings or margin into customers, but there's no change in sight. Will they ever be profitable? I have serious doubts about it.
Yeah, I think it would be interesting analysis to see other industries and what revenue growth rates and profits do other mature industries have. Because if you think about it just from pure microeconomic perspectives, and having, hundreds of companies, each of those is, growing 10% and has 30% profit, that sounds quite unrealistic that, every company is profitable, because then just new entrants come in, they destroy this profitability to some normal return to capital.
Yes. I mean, everybody thought that everyone can build another Adobe or another Salesforce that will make 20 to 30% EBITDA at massive scales. But I think too many people had the same idea at the same time, and it just proved impossible for everyone to make this kind of money if everyone's doing the same, basically. So it's a very tough and competitive environment in which SaaS companies have to trade business. So what next, Philip? What question do we take?
There's one kind of continuing on that. What's the best guess on EBITDA margin for SaaS business?
A mature
SaaS business.
The end state, kind of equilibrium. Yes.
Yeah.
I mean, yeah.
10 to 20%, I would say.
And that would be very healthy.
Yeah.
And I think, but that's probably 5-10 years from now. And once really the industry consolidates, matures, and the AI hype goes away, I think we will see what is typical for other industries, other mature industries. So something like healthcare, business services, logistics, this kind of stuff. So this will be probably, I don't know, from 5 to 20%, but I think 20% will be an outlier. 10 to 15% will be probably what we can expect going forward. I mean, these are not also capex heavy businesses. So that's why EBITDA margins can be a bit lower because they don't need replacement capex.
Yeah, I'm seeing S&P 500 net profit margin is 12%. So EBITDA margin probably 15%, 16%.
Yeah, I would expect that. Yeah, low growth, like 5-10%, or maybe even in line with inflation. Maybe a bit higher, and yeah, maybe 15% EBITDA. Good. Next one. A question from Adam. How about companies are not listed companies? Can they be evaluated on EV to revenue growth? Absolutely. I think it's a great metric to benchmark investments, essentially, assess investments. How much are you paying for a unit of growth? Yes, absolutely. Okay, what other questions?
There's one about stock-based compensation, whether it's sustainable long term, that a lot of companies are having negative EBITDA, high R&D costs, negative unlevered FCF, and they stay afloat for equity funding. Stock-based comp, is it actual sustainable long term? I mean, honestly, I personally looked at this for quite some time. Like 3-4 years ago, we were looking at SaaS companies and their stock-based compensation, and we thought, oh, it's not sustainable. But somehow it still works. Yeah, still a lot of compensation of employees is in stock options, and people agree to this, and there is no major change. Maybe just some companies start to buy back shares to avoid dilution, but otherwise, I think it's going to continue like this.
I think we need to look earlier in the development of these companies at early stage companies, startups, basically. That's one thing. And I think at Gen Z, and you're closer to Gen Z than I am, or some would say you are Gen Z. I think Gen Z will be more risk averse and will be less inclined to accept stock-based compensation. And as these companies grow, they may be leveraging this less. Also because a lot of people who joined startups in the last 2 years will probably be disillusioned because IPOs, it takes longer for these companies to IPO, it takes longer to exit. So I think people will just want cash comp rather than stock-based compensation. However, there are exceptions, high-flying companies. I mean, I would take stock-based compensation in NVIDIA. I mean, NVIDIA has produced so many millionaires.
Yeah.
It's unbelievable. So, so for high-performing teams, I think it's essential to have stock-based compensation as part of the overall package. Okay, what else?
I've seen an interesting question about the difference between SaaS and licensed companies in terms of business model and metrics multiples. I mean, perpetual licenses, companies that have perpetual licenses, I don't think there are too many. Those are super difficult to sell overall. And the multiples there, what we've been seeing, are based on EBITDA most of the time, just because your revenue is not really recurring, or recurring, but the renewal rates are not very high. But if it's a subscription or subscription and maintenance business model, just which is delivered not SaaS but on-prem, I don't think that's a big discount there. There is some discount because investors think you have technical debt and eventually you'll need to move to SaaS or develop a SaaS solution. But otherwise, valuations there could be quite similar.
Yes. Okay, I see another one. What deals are you guys working on that you feel confident that will close? Which industry verticals? I would say that industry verticals are irrelevant. The biggest differentiator between good quality companies and companies that are less likely to find a buyer is churn. So low churn companies tend to be easy to sell because they offer predictable cash flow, even if there is some disruption. You can expect the business to continue for the years to come. And a lot of companies that have high churn, we see their customer acquisition cost explode or growth decelerate, and these tend to be very difficult to sell. So the market is much more selective now and is looking for quality. Still, quality gets good valuations, but I think it takes a bit more time to find a buyer, and people try, do more due diligence on these companies and look more closely on the business model. So the times when the COVID times are long gone, when you could sell very quickly any SaaS business, really. Okay. Fib, shall we wrap?
Yeah, I think we can wrap up.
Okay. So it has been very encouraging to see so many of you join. Thank you for your attention. It's always a pleasure when we can share our findings and motivates us to have these conversations with you and to get even more insightful and crunch more numbers and get closer to the truth. Big disclaimer, we don't know the future. We try our best, but we don't know what's going to happen. So please take all of everything that we say with a grain of salt. But we do our best, so I hope you find our insights valuable. And we'll see you next time. We'll be reaching out with our next invitation, which will probably be another sector. I think we can cover IT services again in our next installment. So thank you so much.
Thank you. Thanks for your time and active participation in Q&A. There are already a couple of ideas for some future analysis that we can do and show on our next webinar. So have a good rest of the day and see you on our next webinars.
Thank you. Thanks, Philip. Thank you, team,
Bye-bye.
for your help with preparing this webinar. Thanks. Bye-bye.
Bye.